Ladies and gentlemen, welcome back to another live stream. Here we go. We are just about 10 minutes away from the decision and then about 40 minutes away from hearing Jay Powell speak. Wanted to come on here and, of course, break things down for you. We're seeing some nice movement in the overall markets. Bitcoin is up over 18,300. Let me make sure I don't have anything in my teeth. Am I all right? I just had some rice. Got some food in me. Man, it's been just a crazy week in crypto. So welcome in, everybody. Glad to have you with us. My buddy Austin's going to be joining us here in a few minutes, I think. He's finishing up, putting up a video over on his personal channel. We're live all over the place here. We're live on my personal channel. We're live on Twitter. We're live on Twitch. Shout out to everybody out there. We're live on the Clear Cryptos YouTube channel. So everybody out there listening, really appreciate you guys stopping into the channel. And let's dive into kind of what we're expecting here. Of course, this is the day 2 of the 2-day meeting. We got the CPI report yesterday. Things came out pretty nicely, and the markets responded and reacted pretty well to it. Now we've got the FOMC meeting here today, the press conference. I've already got it pulled up, ready to go. Should go live at 2:30. So there we go. Let me know in chat. Can you guys hear that music? Just want to make sure. I think I've got everything figured out now. So let me know if you guys can hear that music. Should we just listen to this for the next half hour? Is that something we want to do? No, I'm just definitely not going to do that. Boca's in the house. What's going on, everybody? Good afternoon. What's up? Let's go. Hello. Travis, what's up? Hello. What's going on? Jerome, how we doing? Ali. It's very light. Here we go. Yeah, it should be a little louder. There we go. Oh. Yeah, they keep cutting out the sound there. I don't know what's going on. Stacks in the house. Bucks go down. Oh, it must be a Michigan fan. Come on, man. Hello. Crypto Hound, what's going on? Here from Florida. What's up? 12 Nation, how we doing? All right, so Bitcoin, guys, on a nice little run here. You can see 18,300. Great to see. We're actually up now 12% in the last month when we zoom out. But this all started yesterday after getting some good CPI numbers come in. We've come all the way up from 16.8 up here to about 18.3. Now, keep your eye on this RSI chart. This last time yesterday where we reached up here on the RSI, we hit like 87 on the RSI. Let me take that chat away. You can see this a little bit better. Put myself right here. We hit 87 yesterday on the RSI, came way back down below 70. Right now, we're well above 70, which this is the overbought zone. Bitcoin is technically overbought right now, sitting way up here at 84 on the RSI. So will we see a little bit of a pullback here once we get the inflation information from Jay Powell and company? We'll see. But things are looking pretty solid here. That's for sure. We'll take some green days in the overall market. We've got some interesting price action here. You know, we talked about Toncoin recently on the channel. It's up 12.42%. It's kind of the altcoin that nobody is talking about right now. Pretty crazy. It's up to $2.57. This is the coin that kind of resurfaced due to Telegram. So the Telegram coming in and basically kind of recasting this vision. So Toncoin is a decentralized layer 1 blockchain developed in 2018 by the encrypted messaging platform Telegram. The project was then abandoned, taken over by the Ton Foundation, and renamed from Telegram Open Network to the Open Network. So very interesting. Sitting at a $3 billion market cap right now, ranked number 22. It could be a buy the rumor, sell the news event. Could be. We're definitely overbought on the RSI. So keep that in mind for sure. Let's see what other some altcoins are doing here. Solana is up 7.45%. It's on a nice little move here. That's good to see. What else do we got here? Quant is back on the move. Grizzly Bear, decentralized layer 1, very different than the other layer 1s out there, super decentralized. But they're kind of recasting their vision now. I want to look into it a little bit more. I made a quick video on it. It's kind of crazy. I mean, it was ranked number 25. Nobody was talking about it, but it's ranked number 22 now. It's still moving up. Pretty crazy. Listening live from Vegas. How we doing, Ish? Welcome, Jonathan Manis, aka the legal. The one-legged bandit. What's up? What's up, Jonathan? And we got Austin Hilton joining us on stream. What's up, brother?
What's going on, man? How are you?
Good, man. Can't complain. Just taking a look at the overall market. We're getting some nice positive price action. Bitcoin is just crossed over 18.3. But I was just saying, looking at the RSI, we're definitely overbought here, sitting at 85. So
that's high. Yeah. So
do we get a buy the rumor, sell the news event here and comes back down into the 1700s? What do you think?
Man, I hadn't looked at the RSI. What's the RSI on Ethereum? I hadn't looked at the RSI rate lately.
That's a good point. Let me see.
Because Ethereum yesterday was lagging in the RSI, right?
It is. Ethereum is still lagging. So it's sitting right at 70, but it's kind of slowly going up. It did kind of meet some resistance again where it did yesterday, right about 1350. And we've come back down a little bit, but you're right. It is lagging on the RSI, where Bitcoin is kind of spiking on the RSI
85
as we speak.
Man,
it is
high. So it should be.
We got up there yesterday and it came down.
Yeah.
I mean, it did correct a little bit. Like that was this kind of move yesterday. We got like that correction right here, but I don't know. I mean, what do you think? Is this a buy the rumor, sell the news, no matter what happens here?
Yes. Well, yeah. Because here's the thing: 50 basis points is built in. 50 basis points is the assumptive number. It's what we expect. And so this is the run up to the event. And I would not be shocked if Bitcoin, that RSI number is like, I didn't know it was 85. That's crazy. And it's probably going to go higher as we inch towards the actual decision itself.
I think so too. We're still running up though right now. I mean, we'll see. We can zoom in a little bit too and kind of track this a little closer. We go into like there's the 15-minute chart, but you know what? I'm going to take this as a win though, no matter what, Austin. I mean, this is a couple days in a row. I mean, it feels good.
Yeah. To have some green. It was up 4% yesterday and I was all over my channel going, woohoo, you know, it's like, and I was like, hey, 4%, that was the market move. 4% up. I'm going to take that as a win, you know,
no doubt.
So
yeah, no doubt, man. Yeah, I'd definitely take a couple wins. People are saying Kevin O'Leary from Shark Tank. Here he is. So these were his thoughts on what Binance did or didn't do, intentionally putting. We were just talking about this, putting FTX out of business. So here's what he said.
Why do you believe FTX failed?
I have an opinion. I don't have the records. Here it is. These two behemoths that own the unregulated market together and grew these incredible businesses in terms of growth were at war with each other. And one put the other out of business intentionally. Now, maybe there's nothing wrong with that. Maybe there's nothing wrong with love and war. But Binance is a massive, unregulated global monopoly now. They put FTX out of business.
Why do you believe FTX failed?
Okay. What do you think? What do you think about that?
Oh, I so disagree. Dude, I have some strong feelings about this. So number one, FTX at its core business was a fraud, period. End of story. Drop the mic, walk off the stage. It was a fraud. They were taking investor funds, sending them to Alameda, doing all that, all the stuff. It was a fraud. It was a Ponzi scheme, period. They did not kill. Binance did not kill. You and I talked about this, whether CZ released the information he had or he did not. He was, I think, were they competitors? Yeah. But what people also don't know is that Binance incubated FTX. You remember that? They did.
Yeah.
Binance Notice Mr. Kevin's not saying a word about that.
That's actually a really good. That's crazy. You're right.
Binance, go back, fact checked me. But I read content back when this thing was going down. Binance was part of an incubation process and incubated FTX.
I think you're right. No, I definitely think you're right. Incubated FTX. Yeah, I think you're right. I think O'Leary's kind of just towing that line because
Well,
I don't know how
again,
involved he was. I mean, but did you hear the number? 15 million to
it
be a
was
representative?
speculated that he was paid $15 million to be a vocal advocate. I don't know when he was paid, all that kind of stuff. So
Yeah.
I'm sorry. I have some significant problems with him going up in front of Congress and saying what he's saying because it's not true.
Mm-hmm.
You know, were they competitors? Yes. Did CZ's action cause a bank run on FTX? Yes. I mean, all that's true, but it doesn't inherently change that the business model was a freaking pyramid scheme. It doesn't.
No, 100%. 100%. Yeah. I mean, there's just no way in hell they could get that big in 2 years. That was my biggest thing. And how are they spending more than all of these, huge exchanges in a 2-year stretch, right?
They were spending customers' money to do all the marketing stuff.
That's how they so when I was in Miami, it's still they still got some signs up like the FTX arena and like Binance doesn't have an arena.
No.
And crypto.com does, but they've been around a little bit longer. I mean, at least they've been around for what, 6-7 years. And
don't get me started, dude. Don't get me. I did get started. There it was. I tell you,
Yeah.
It's just how many we got? How many we got live with us here?
On my channel here, about 140. I don't know how many people are over on the CCX, but we're live on Twitch and on Twitter. Usually we get people listening on Twitter, so I can only see the one number here. But yeah, make sure you guys hit the like button, subscribe. We're going to be listening to J Powell here in a little bit, and we should be getting the numbers here, so it just should go public now. So let's see what we got here. Let's see. Breaking news. Let's see. That's not it. Let's see. FOMC. Let's see.
Just go to pull it up on YouTube.
I've got the press conference, but that's at 2:30. But yeah, you're probably right. We could go live. FOMC. Somebody's probably talking about it just in general. Oh, look at Chad. Chad Redding's got 1.3K people. Oh, my gosh. What's up, Chad?
I like Chad.
Chad's been live for a bit. Man, he's got a ton of people hanging out with him. That's crazy. That's awesome.
Can't let Chad beat us. Can't let him beat us.
No, that's awesome, man. He's been live for a minute. Here, let's see what Bloomberg's talking about here. We'll see if we can jump in here. Guys, make sure you guys hit the like button on your way in. That helps us out tremendously. Let's see here. Let's see what they got.
As the Fed tiptoes close to saying we will have a recession next year, they raise the outlook for inflation and unemployment. GDP for 2023 is seen at only half a percentage point, down from 1.2% in
50.
September. 2024 is trimmed by a tenth.
Does it already come out?
6%. Unemployment ends next year at 4.
Wait a minute. What? Pause that. What?
Than they had forecast in.
He hasn't given his speech yet.
No, but the report comes out like around 2:00, and then he goes live 2:30 usually.
Oh yeah, okay. So it is. So the number's in. It's 50.
Yeah, it should be FOMC 50 basis. I'm just looking for like an official report here. 50 basis point hike as expected. So yeah, it's coming in now. Let's see. Are we getting an official outlet? It's 50. FOMC 50 basis point increase approved. No changes to the statement. Most officials see rates ending 2023 between 5 and 5.5%. Most officials see rates ending 2023.
Okay, and we're at so they're talking about the aggregate number that's so we're at like 4 and we're at like 4.75 right now. I think 4.5. Let me see. What is the? Let me see what the number is.
Bitcoin's taking a little bit of a dip, and actually a lot of bit of a dip. Look at this.
We called it.
We just said this. Yeah, it was oversold tremendously, and it's definitely a buy the rumor, sell the news. We are under 18,000, just like that. Now let's see what happens, though. Where does the falling knife stop here?
We called it, dude. Yeah. Should have been trading. We called this, dude. We're like, it's gonna happen.
Reported the market 5 minutes ago, and we'd have been, yeah. Look at that.
We're brilliant.
That's insane.
Everything's taking a dip. Somebody said meditation and relaxation. Great screen name, by the way. SHIB took a dip as well. Yeah, everything's gonna dip. If Bitcoin's dipping,
Yeah, on these candlesticks here, the whole market's going to be dipping, no doubt.
But it makes sense, right? It's the run up, it's the speculative run up, and then we get the news, yay! Okay, and then everybody's like, profit, 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 profit. You know?
Classic buy the rumor, sell the news, right?
Yeah, man.
I mean,
yeah.
but
Yeah.
here's the thing: could it pop back up when Jay Powell takes the floor? I think so. Here's the thing: I'm not really concerned about the 50 basis points. I'm more concerned about what he says is the plan for next year. What's the plan for moving forward?
Yeah, hawkish,
that's what I want to hear.
And that's what everybody's. And we could, if he says the word "the" wrong, hawkish, then we will, we'll see some dives, right? So. Yeah. So like pull up Yahoo Finance and see, I bet you're seeing the same. You'll go to finance.yahoo.com and then you'll see the exact same thing. I bet you the market
the Dow and
Dow's. It's been up. Yeah. It's been up 200. The Dow 30 was up 210, down 38. There you go.
Yep. Look at the S&P.
Yeah. Yeah.
Yeah, you're gonna get. It's crazy how much crypto has really followed the stock market this year too. Yeah, the Dow's down, Nasdaq's down. So yeah, I mean to be expected here. It's definitely a buy the rumor, sell the news. Stocks. Fed raises interest rates by 0.50%, bringing rates to highest since 2007. So there
What's
you go.
The aggregate number though? If they raised it 50, where does that take us at so anybody know in the chat, somebody in the chat, drop in. So the lending rate, what's that number now? Is it 4.5? It's in the fours. I know it is because I'm coming back to your comment, Zach, earlier.
Here we go. Federal funds rate to a new range of 4.25% and 4.5%. There you go.
So go back to your comment earlier, Zach. You said you were looking at something earlier that said they want to get it to 5.5.
Yes, that was right here, this tweet. So most officials see rates ending 2023 between 5 and 5.5%.
Okay. So that's speculative, right? So here's what it comes down to. Either A, do we have another 50 basis point raise because we're not having a meeting in January. We're having a meeting in February of the Fed. The FOMC next meeting is in February. So do they raise it 50, which would get us to say 475.5?
Right.
Okay. And then cool off? Or do we raise it 25 basis points? Maybe we get some smaller basis points raises along the way. That's the key, I think, that everybody's going to be focused on. And probably even with Jay Powell, Zach, I want your opinion, is that's probably fundamentally what they're going to be looking at is like, okay, are you going to you're going to downshift to maybe smaller, quarter, not that he's going to say those words, quarter basis points, but does it equate to that? Right.
And I think the journalists are really good in this situation. I think that's what everybody's thinking. So they're going to ask those questions. Now, does he answer them directly? His typical response is always, his go-to response is always, well, we're going to let the data indicate the moves we make moving forward, right? The data will drive where we go next. So wait till I get the data. But I mean, if we can get any kind of news regarding that, put it this way, is there anything he could say in that regard that would actually give us confidence in the market?
I think Jay Powell is going to be, this is a risk discussion and it's going to move it further. If he even remotely says anything hawkish, which he will, Zach, he's not going to say everything dovish because he has to address the elephant in the room. And the elephant in the room is they've got to go from 4.25 to 4.5 to 5.5. There are more rate hikes coming. It's how we get there.
Exactly.
Nobody wants to hear him say that or talk about it, but that's the reality.
Yep.
So so there you go. So I think we're gonna move lower.
So this guy, the Martini guy, says FOMC is tapering off interest rate hikes, incredibly bullish for Bitcoin. I mean, at least one time here, he's went from 75 to 50, but I hear that it is bullish in the short term for sure. Let's see.
It's going to be 50. This is nothing new. Wow, it's really
to be expected. Yeah. Oh yeah, coming down. That's a 5-minute look, guys. So let's go into the half hour here. There's just like your one candle, basically.
We knew this was coming.
Yeah, we consolidated quite a bit here. I'd be surprised if we, somewhere in here, I think we stopped the bleeding stops like 17.7, 17.6. But it's still, that's still up from where it was before we got CPI. Before we got CPI, we were at 16.8.
Yeah.
So all in all, I mean, it's still a pretty good move. So let's see here. Let's see what they're talking about over here on Bloomberg again. And we've got Jay Powell talking in 20 minutes. So he'll be taking the stage in 20 minutes here. So let's see what they're saying here.
You know, what I was surprised is how big the dispersion is as we get out further.
3-1 to 5-6 in 24.
Right. I mean, John, what really is striking to me is no one is saying that there's any likelihood that they would possibly cut rates in the second half of the year. And I think, you know, the market is obviously starting to discount that. So, you know, the slowdown in the economy and all the inflation data that we're getting that is showing that deflation is decelerating rapidly, and some parts of the economy are falling into deflation, they're completely discounting based upon wage growth. And I candidly, you know, when I was an advisor to the Fed 5 years ago, the whole discussion was around how do we get wage growth to go up. Now, for some reason, you know, wage growth is bad, and is this President Williams said, you know, is the core of the onion. I think that that's not the appropriate perspective the Fed should be having.
So, Scott, if you don't believe what they're selling today, from your perspective, is that bullish or bearish for this market?
Well, it depends. I mean, for rates, John, it's bullish. For the stock market, I think it's bearish because, you know, we've never seen the stock market bottom before the Fed stopped cutting rates. So, you know, I think longer duration Treasury securities are a great place to be. High quality corporate bonds are probably, you know, an okay place to be because you'll get lots of income off of them. But, you know, high yield bank loans, real estate, you know, stocks are all probably things that are going to continue to come under pressure. And, you know, that's the position that we're taking. The other question is how far will the curve invert? You know, 2s, 10s could get to 100 basis points, but if the Fed is caught offside and inflation comes down harder than they expect and the economy stalls out, you know, the likelihood is that we could get a curve steepening in the second half of the year. But for now, the inversion is probably staying with us.
As people digest the statement, we are seeing a bit more of a predictable response. We now see the NASDAQ down 0.8%. Two-year yields are now higher on the trading session to 4.3%. Still, nonetheless, not massive moves considering how much some of the projections went against market expectations. Let's bring in Diane Swong, Chief Economist at KPMG. Diane, from your vantage point, is it notable that the market is not buying what the Fed is selling and that they're still pricing in Fed rate cuts by the end of next year?
Well, of course we are.
Yes, it is notable. And I think there's two things going on. One is the speech that Chair Powell made, the last speech he made before we got this was very hawkish, yet his Q&A that came out of that was much more nuanced and less hawkish. And I think that set the stage for, even if they go in hawkish with these SEPs, the Summary of Economic Projections, and a more hawkish move by the Fed, that it could be tempered by what Jay Powell says. I'm not sure that's going to happen, but I think there's another issue that's very subtle, and I want to just take a little issue with Scott. I love Scott, but the Fed is not against wage gains. What they're trying to do is bring down inflation more rapidly than they bring down wages, so that wages ultimately outpace inflation. Right now, we do have a situation where they're concerned, whether they're right or wrong, they're concerned that there's a floor on inflation because of how high wages are, and a lack of productivity, and moreover, that the job shortages, the labor shortages we're facing are now secular rather than cyclical in nature. That means a higher non-inflationary unemployment rate going forward. You really heard it in Jay Powell's.
All right, let's pause this. I'm tired of hearing these people talk.
So what do you think about all this? What do you make of all this?
Well, I mean, master of the obvious. Are we going to have more rate hikes? Yeah.
Yeah, we're not done. I mean, what are their goal? What's the goal for inflation?
It's always funny how you can have such, you know, they can talk a lot and they don't say a damn thing. I think the long and short of it is, dude, I think that the first half, I think it's going to be painful. I think I think the first half of 23, I think we could still see, crypto, Bitcoin moving down south of 12, maybe 10, and Ethereum moving down. And I don't think I think you and I have these ongoing dialogues, and we talk to people that we know and we trust that are extremely smart people. And a lot of them are saying very similar things. And there's not one huge key, big event, right? It's going to happen. I just think there's more downside risk in the first half of 23. And that's really what I'm factoring in as it.
Yeah. And everybody who's just checking in, it's really easy just to check in and see this big red candlestick and be like, oh my gosh, what's going on? And just start freaking out. I mean, this is where we came, right before the CPI data, though. I mean, we came here from 16,800. We're still at 17,900. We're still up over $1,000 on the price of Bitcoin pre-CPI data. So this was more of a buy the rumor, sell the news on the 50 basis points. We kind of knew exactly what we were going to get with the 50 basis point move, and it was already baked in, obviously. And, we kind of were looking at the RSI a little bit. We saw this kind of getting well over the 70 mark. We got the sell-off. Now, what's interesting is, though, could this get oversold a little bit? I mean, where do we kind of bottom out here and start moving sideways? I'm guessing probably
J-Powell now. Now they're waiting to see what J-Powell has to say.
Yep, and kind of see which way that pushes the market here in the short term. So, Austin, you mentioned it, like, get ready for a volatile, rocky, what do you think? First and second quarter next year?
I think definitely first quarter. So we're going to get a jobs report and a CPI inflation report in January. That'll be December's numbers. The one economist was talking about, well, he said a lot, and I frankly tuned out about half of what he was saying. But but I think that we get a little bit of a break. But here's the thing, and you and I were talking about this earlier: the inflation, stagflation, and deflation, right? Mm-hmm. And I think the issue that we have, and I'm going to go back to what you talked about when we talk about those numbers. We're currently at like 4.25, 4.5. And the Fed's come out and said they want to get us to about 5.5. So that says we got another point to go, or give or take. And is that going to be a 50 basis points raise in February, followed by maybe some quarter basis points raise? That's what we have to see. With all that said, I think that we've seen most of the fallout from FTX. We're still waiting for Genesis, what happens there or not. Okay. So I think a lot of the bad is already baked into the market. Yep. But I think that first quarter is going to be very, very rocky. I think that it will. And that's based off of not my data that I've done. That's based off some people that you and I talk to on a daily basis that say, this is kind of what we're seeing. And I think that's just risk.
Does in your estimation, does the stock market and crypto bottom in the first quarter of 2023?
I do think so. But what I always come back to, Zach, is that I would love for somebody, here's what I don't have. I would love for somebody to say, if this happens, or this and this and this happens, then we will see a decline in stock. We will see a decline in crypto. All we get when we talk to the people that are doing the TA is just that we think Bitcoin can go to 10. We think Ethereum can go to 5, but there's no signal. There's no flash event. There's no, this thing happened. Right. And that's my only real X factor here, man, I'm always kind of looking for events, or what moved it in that direction. Right.
Right.
And if you,
that's a good point.
Yeah. But if you look at this year, what happened this year? Inflation, Federal Reserve, seven Federal Reserve rate hikes this year. By the way, more than any ever in the history of time, 7 interest rate hikes this year. So you have inflation, 7 interest rate hikes. Every single month we would get pummeled by that process. Oh, by the way, Celsius, Three Arrows Capital, Luna crashes. Oh, by the way, Russia-Ukraine war. Oh, by the way, FTX, SBF. You add all that up, like, well, of course we're where we're at. But you look at first quarter and go, is there something out there in Q1 in that lineage of what I'm talking about? And I don't see it right this second. You know what I mean? I don't see an
100%.
event.
Yeah,
So
yeah,
there you
no, really good points, and it'll be interesting. I think you're right. I think really tracking like the more potential fallout from FTX is something big, because that's something we can't see.
Genesis is still out there, and Genesis has gone quiet. So if we get a Q1 Genesis defaults and it impacts all of the crypto lending, and again, dominoes, right? You see the staking lending platform start to go down by dominoes. Genesis has gone quiet on us. So maybe they got some money. I don't know. Hopefully they did, right?
Yeah.
That's an entire sector that can be gutted again inside of crypto.
Yeah, 100%. I'm getting an echo on my end. Are you getting an echo?
I am not.
Okay. We'll keep rolling with it. Now it's good. Ray says, what do you think about crypto now? Do you think it's going to reverse? So, Ray, I think you just joined us. Yeah, we're kind of talking about this. By the way, guys, welcome into the live stream. We got Jay Powell going to be talking here in about 10 minutes. So make sure you guys hit the like button, subscribe here if you haven't already. If you're over on the Clear Cryptos YouTube channel, subscribe over there as well. Some of you on Twitter. Shout out to everybody here who's with us here this afternoon. But Ray, we were just talking about this. If you guys are just tuning in, we're expecting a lot more volatility here the next 4 to 6 months. Much of the same in 2023 to start off the year. I mean, we're guesstimating here as well, right? But I think what we're really saying is there's really no positive catalyst that can get us out of this mess we're in right now. But here's one thing I kind of look forward to, Austin. Like once we do reach the bottom, we're going to have probably a long period of time where we can accumulate. Because usually what happens at the end of these bear markets, it gets extremely boring and you just get this sideways action. So if we do get this Ethereum drop to 500-600, if we do get this Bitcoin drop to 10 or 12 or 14,000, wherever that bottom ends up being, the more it moves sideways, the more clarity we have that we've reached the bottom. It gives a lot of people opportunities then to get in. And usually that period lasts for a very long time and you slowly start building. And then obviously, like so many of us, I mean, we're looking at these opportunities. This is where Bitcoin was, guys, in 2017. These are the opportunities that you have right now. Yeah, this is where Bitcoin's price is. This is where, I mean,
I didn't know that until you told me. You pulled up that article talking about the fact that Bitcoin, where it's at right now, because we all talk about this. I wish I would have bought Bitcoin back in the day.
5 years ago. Here we go.
You buy Bitcoin today, it's 2017 prices. I'd love that. That's awesome. Yep. I want to go to something you said. Let's just say, so here's the silver lining, right? And you and I talk about this on our respective channels all the time. We talk about the fact that it is what it is. If Bitcoin goes to 10, if Ethereum goes to 5, I'm buying. Period. End of story. Okay. Because I'm locking in those lower costs, and it's going to go where it's going to go. That's also a big part of it. Okay. Oh yeah. Subscribe to that guy's channel. He's actually not bad. I heard some decent things about him.
Check out Austin's channel, guys. If you're not yet subscribed, check him out. Seriously. Great content creator, shows up every single day. And
even when he's got a fever.
Shit, man. Always. That's half the battle, man. You got to show up.
I got to tell a story on Zach. I was sick one day about 2 weeks ago. I was sick and I wasn't going to make a video. And Zach calls me. He's like, dude, you have not missed a day in almost 2 years. You got to make one video. And I literally walked out to my backyard and I literally had my phone about to push record and I threw up and then I made the video.
That's dedication right there.
Dedication. Yeah, that was funny. I mean, and you were like, how'd you do? I'm like, well, I threw up twice, but I'm good.
The video's out. That's good stuff.
That's funny. Okay, so here's the thing, man. I mean, because I want to go to something you said, Zach. You said basically, look, if we go to 10 and we go to 10 in the first half of the year, and you and I were talking about this off camera, if it goes to 10, Bitcoin, don't believe me. Go look at the charts. Go look at the numbers. Every single time it comes down, it goes up exponentially more. So if it goes to 10, then it's going to go to 100,000 in its next run up. It's going to go up to 100. It's going to drop. Then it's going to pull back. It's going to pull back to say 30 or 40, whatever that number is. And then what's it going to do? It's going to go to 180, 200. It does this. Bitcoin, don't believe me? don't believe me. Go look at the charts. Go look at the numbers. It's this cycle that Bitcoin does. You know, that's the good news, right? So
yeah,
anyway.
I mean, I'm gonna try to find that actually. We got Jay Powell speaking, guys, in 6 minutes. But Austin's right. I mean, I found this Bitcoin bear markets history. Hopefully this pops up. Yeah, here you go. So check this out. Okay, if you're just kind of listening into this and thinking, man, if Bitcoin gets down to 10K, what an opportunity this would be. This is just how big some opportunities have been in the past. Bear market number one, Bitcoin crashes from $32 to 1 cent in 2011. Crazy. Can you imagine getting Bitcoin in 2011 at 1 cent? Now, how many people that had Bitcoin and watched their Bitcoin go, maybe they had it at like $30 and it started going down all the way to $1 and they got out and they never came in. They said, oh my gosh, I'm done, right? It was so easy just to be done with it. Make your money and get out. Yeah. Well, look what happened next. Bitcoin tanks from 1K. So it got all the way back up to 1,000 from 1 cent 4 years later to below. And then it tanks all the way down to 200 in 2015.
Pause there for a minute, Zach, because that's pause there because that's a good point right there. It took 4 years. Okay. And that's what most people are not factoring in. They're going
to retest previous high 37 months.
And so people are not looking at the time. They're like, well, it didn't go from 10 to 40,000 in 3 months. Oh my God, blah, 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 blah. That's the point is people don't look at these longer time cycles. And that's, you get my point,
Yep. And that's usually, here you go. The first one, just to kind of show you time to retest previous high, 20 months, June 2011 to February 2013.
The vast majority of people can and will not wait for that. They won't.
Exactly. And so the number 3, check this one out and look what we're looking at, 36 months. Yep. Number 3, Bitcoin plunges below 3,200 after hitting 20,000 in December 2017. So that was the high in 2017, right? That's been right around the low right now in 2022. Time to retest previous high, 36 months.
Yep.
And then here we are today.
Yep.
And we'll see. I mean, this will be updated because we're actually in an extended bear market. So we'll see where this goes. But I mean, if history repeats itself, we're okay. We're okay.
Well, it's the cycle. And that's what's amazing to me is everybody's running around with their hair on fire going, the sky is falling, and this is horrible, and this is horrible. But this is the cycle. I mean, Zach just proved it to you. That is the cycle. That's going back however long it went back. It's the cycle. It's the cycle of life, of crypto life. There you go, right?
I mean, there are some people who say that maybe the 4-year cycle will be broken because of new people coming in. I do think the bear markets will last for a shorter time frame eventually, just because there's going to be more people trading. There's going to be more people coming in. And, when adoption ramps up, less sell pressure.
Yeah. Institutional money, all that.
Exactly.
Regulation will shorten that time. Regulation will shorten that window.
It's going to get, yeah. I mean, Bitcoin eventually will get less volatile. It will always be a volatile asset class, but it will get less volatile when there are more big money people in it.
But also when you say Bitcoin, to me, it's Bitcoin, Ethereum, blue chips.
Yes.
It's all of the above.
Yes.
Right?
100%. No, you're right. 100%. Yeah. It's kind of synonymous. Yeah, you're right. It's like synonymous when I'm saying Bitcoin right now. Like, yeah. Crypto in general will become less volatile. The blue chips.
Go look at that last comment. Aristotle's calling me out. Calm down. That's awesome. Thanks, man. Very wise one.
What
He said, "I'll calm down, Austin. Please, no one knows future performance." Yes, sir. I will calm down. Thanks for the comment. That's fun.
Yeah.
Thanks, man.
No, I mean, nobody does know the future. I mean, we're just going off of, historically speaking here with the bear markets we've seen. I mean, this is to be expected. Like, it just feels worse, I think, because of all the FTX garbage and all the contagions and the way the media is talking about crypto. But it's normal. These markets, the market cycles that we're seeing are normal in terms of price.
Well, to your point, dude, go listen to people that have lived through Bitcoin and Ethereum, but lived through it for 5, 6, 7 years. And they all tell you the same thing. These are cycles. This is what it is. And this is and they all say the same thing. Hey, he's not live yet. Yeah.
Yep, 2:30. So we're about a minute away, ladies and gentlemen, from listening to Jay Powell. So appreciate you guys hanging out with us. A little over 250 people on the channel here. We've got people listening on Twitch. We've got people listening on Twitter, over on the Clear Cryptos YouTube channel. So appreciate you guys. If you're with us, haven't hit that like button, do so. Really helps us out. It's totally free. Push us up with the old algorithm.
I just lost one subscriber. I wonder if that was Aristotle or somebody.
He just unsubscribed over there.
I'm out. Okay.
People, man, I'll tell you what, man. People,
oh, I just lost another one. Oh, I'm losing people. All right, go show my channel. I got to get 2 people back.
People, I'll tell you what, man. People are very,
it's funny.
Short-circuited in the bear market, you know. But yeah, guys,
that's funny.
Subscribe to Austin over here.
Subscribe to me. I just lost 2 people. I'm begging for subscribers, please.
Yeah, man.
Oh, that's funny. All right. So yeah, so we got a minute. He should be nice. See if he's live now.
Should be coming on live here. Here we go.
Foxy's there he is. Foxy's asking, do we think it'll be hawkish or dovish? I think it's going to be hawkish because he's got to talk about the fact that he's got to raise rates.
Yeah.
You know?
I agree.
The final phase, the last comment said, laugh out loud. They triggered. That's awesome. Okay.
We're waiting on them to come up here. Josh, thanks for the update. You guys are awesome. Appreciate you, Josh. Oh, they're triggered. If it wasn't for viruses, we'd be on the Windows 3.1, but look at where we are today. Listening from the mountains of Colorado. You guys are awesome. What's up, Gilbert? How are we doing?
Oh, Gilbert, that just makes me mad. From the mountains of Colorado. I wish I was there. That's awesome.
Here he comes.
Here he comes. Oh, is he walking hawkish or dovish?
Over, under.
Over, under. Yeah. All right, I'll shut up. Go.
Good afternoon. Before I go into the details of today's meeting, I'd like to underscore for the American people that we understand the hardship that high inflation is causing and that we are strongly committed to bringing inflation back down to our 2% goal. Over the course of the year, we've taken forceful actions to tighten the stance of monetary policy. We've covered a lot of ground, and the full effects of our rapid tightening so far are yet to be felt. Even so, we have more work to do. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by 0.5 percentage point. We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In addition, we're continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive policy stance for some time. I'll have more to say about today's monetary policy actions after briefly reviewing economic developments.
Zach, pull up the trading view chart. I want to see, because he just admitted that he was going to do it.
Although real GDP rose at a pace of 2.9% last quarter, it is roughly unchanged through the first 3 quarters of this year. Recent indicators point to modest growth of spending and production this quarter. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. As shown in our summary of economic projections, the median projection for real GDP growth stands at just 0.5% this year and next, well below the median estimate of the longer run normal growth rate. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate near a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 272,000 jobs per month over the last 3 months. Although job vacancies have moved below their highs and the pace of job gains has slowed from earlier in the year, the labor market continues to be out of balance, with demand substantially exceeding the supply of available workers. The labor force participation rate is little changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices. The median projection in the SEP for the unemployment rate rises to 4.6% at the end of next year. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in October, total PCE prices rose 6%. Excluding the volatile food and energy categories, core PCE prices rose 5%. In November, the 12-month change in the CPI was 7.1%, and the change in the core CPI was 6%. The inflation data received so far for October and November show a welcome reduction in the monthly pace of price increases. But it will take substantially more evidence to give confidence that inflation is on a sustained downward path. Price pressures remain evident across a broad range of goods and services. Russia's war against Ukraine has boosted prices for energy and food and has contributed to upward pressure on inflation. The median projection in the SEP for total PCE inflation is 5.6% this year and falls to 3.1% next year, 2.5% in 2024, and 2.1% in 2025. Participants continue to see risks to inflation as weighted to the upside. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a 0.5 percentage point, bringing the target range to 4.25% to 4.5%. And we are continuing the process of significantly reducing the size of our balance sheet. Today's action
What's up?
Raised interest 4.25 percentage points this year.
Where's that audio coming from? Me?
I still have it up. I want to hear it a little bit in the background.
All I was going to say was we're at 7.1 and they want to go to 2. That's a massive.
Long ways away.
So that's it. Go ahead.
Long ways.
Yeah.
Yep. He just said it again.
In the course of the year, financial conditions have tightened significantly in response to our policy actions. Financial conditions
2%.
fluctuate in the short term in response to many factors, but it is important that over time they reflect
What's going on, Jay Powell?
the policy restraint that we're putting in place to return inflation to 2%. We are seeing the effects on demand in the most interest-sensitive sectors of the economy, such as housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee decided to raise interest rates by 50 basis points today, a step down from the 75 basis point pace seen over the previous 4 meetings. Of course, 50 basis points is still a historically large increase, and we still have some ways to go.
That means more rate hikes.
The median projection for the appropriate level of the federal funds rate is 5.1% at the end of next year, a 0.5 percentage point higher than projected in September. The median projection is 4.1% at the end of 2024 and 3.1% at the end of 2025, still above the median estimate of its longer run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. Our decisions will depend on the totality of incoming data and their implications for the outlook for economic activity and inflation. And we will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible.
The data will
We're
drive
taking forceful steps
everything.
to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the long run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country.
Yeah.
Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I will look forward to your questions.
Ugh. It was not very good.
CNBC. Thanks for taking my question, Mr. Chairman.
Same thing you always said.
Importance of market conditions reflecting the policy restraint you put in place. Since the November meeting, the 10-year has declined by 60 basis points. Mortgage rates have come down. High yield credit spreads have come in. The economy's accelerated, and the stock market's up 6%. Is this loosening of financial conditions a problem for the Fed in its effort and its fight against inflation? And if so, do you need to do something about that? And how would you do something about that? Thank you.
So as I mentioned, it is important that overall financial conditions continue to reflect the policy restraint that we're putting in place to bring inflation down to 2%. We think that financial conditions have tightened significantly in the past year, but our policy actions work through financial conditions, and those in turn affect economic activity, the labor market, and inflation. So what we control is our policy moves and the communications that we make. Financial conditions both anticipate and react to our actions. I would add that our focus is not on short-term moves, but on persistent moves and
pause that.
Conditions over time.
Yeah.
Here's the thing. The 2% number is nothing new. So what he's basically saying, right, just to clarify.
That's the long-term goal.
Yeah. So just to clarify, to make sure that everybody knows what we're talking about, they're talking about basically the CPI number that comes out, which we're currently at a 7.1% number. That's the one we got 2 days ago, whatever, right? So he's talking about getting that to 2%, just to make sure that everybody's on the same page. But here's the funny thing. Because we watched his last speech, he has said the word 2%. He has said 2% way more times in this speech than he ever has in any previous speeches. Okay.
And he even gave a projection in terms of when they would get there, 2025.
Correct.
But at some point, they don't have to continue to raise interest rates in order to get there. What's that point, I guess? That's what I want. Is it 4? Is it 4.5 to where like, okay, now we don't have to raise interest rates anymore?
Well,
now
that goes back to that.
It'll just naturally get down there.
But that goes back to our discussion earlier. They've said that they want to take it from, it's currently 4.5. That's the rate, the effective lending rate. And they said that they wanted to get that number to 5.5, unless I'm missing. So that's not that far, but those are different numbers. So my point here is that he is leaning heavily into the 2% number. And that's the overriding message he's really sending, right? Is that we have a long way to go from 7.1 to 2%. Okay.
Copy.
And he's never leaned that much into this. And so he said the word 2% like 10 times there. I mean, it's crazy.
Yeah.
Anyway, go ahead.
I would say it's our judgment today that we're not at a sufficiently restrictive policy stance yet, which is why we say that we would expect that ongoing hikes would be appropriate. And I would point you to the SEP again for our current assessment of what that peak level will be. As you will have seen, 19 people filled out the SEP this time, and 17 of those 19 wrote down a peak rate of 5% or more, in the 5s.
5%.
So that's our best assessment today for what we think the peak rate will be. You will also know that at each subsequent SEP during the course of this year, we've actually increased our estimate of what that peak rate will be. And today, the SEP that we're published shows again that overwhelmingly FOMC participants believe that inflation risks are to the upside. So I can't tell you confidently that we won't move up our estimate of the peak rate again at the next SEP. I don't know what we'll do. It will depend on future data. What we're writing down today is our best estimate of what we think that peak rate will be based on what we know. Obviously, if the inflation data come in worse, that could move up, and it could move down if inflation data are softer.
Right.
Gina. Gina Smiley, New York Times. Thanks for taking our questions. The SEP, like you mentioned, suggests that the Fed will be making another 0.75 percentage points worth of rate increases in 2023. I wonder if you would foresee that being in 25 basis point increments, 50 basis point increments, sort of how you see this.
Not going to give an answer.
Forward. And then I wonder what you're looking at as you determine when to stop.
Good question.
So
not going to answer it.
Watch, you ain't gonna answer it.
So
the data. The data.
As I've been saying,
the data.
As we've gone through the course of this year, as we lifted off and got into the course of the year, and we saw how strong inflation was and how persistent, it was very important to move quickly. In fact, the speed, the pace with which we were moving was the most important thing. I think now that we're coming to the end of this year, we've raised 425 basis points this year, and
425
territory. It's now not so important how fast we go. It's far more important to think, what is the ultimate level? And then at a certain point, the question will become, how long do we remain restrictive? That will become the most important question. But I would say the most important question now is no longer the speed. So, and that applies to February as well. So I think we'll make the February decision based on the incoming data and where we see financial conditions, where we see the economy.
Data. Told you.
And that'll be the key thing. But for that decision. But ultimately, that question about how high to raise rates is going to be one that we make looking at our progress on inflation, looking at where financial conditions are, and making an assessment of whether policy is restrictive enough. I've told you today we have an assessment that we're not at a restrictive enough stance, even with today's move, and we've laid out our individual assessments of what we would need to do to get there. At a certain point, though, that we'll get to that point, and then the question will be, how long do we stay there? And the strong view on the committee is that we'll need to stay there, until we're really confident that inflation is coming down in a sustained way, and we think that will be some time. Now, why do I say that? If you look at you can break inflation down into three sort of buckets. The first is goods inflation, and we see now, as we've been expecting really for a year and a half, that supply conditions would get better, and ultimately supply chains get fixed, and demand settles down a little bit and maybe goes back to services a little bit, and we start to see goods inflation coming down. We're now starting to see that in this report and the last one. Then you go to housing services. We know the story there is that housing services inflation has been very, very high and will continue to go up, actually, as rents expire and have to be renewed. They can be renewed into a market where rates are higher than they were when the original leases were signed. But we see that the new leases that the rate for new leases is coming down. So once we work our way through that backlog, that inflation will come down sometime next year. The third piece, which is something like 55% of the index, PCE, core inflation index, is non-housing related core services. And that's really a function of the labor market largely. The biggest cost by far in that sector is labor. And we do see a very, very strong labor market, one where we haven't seen much softening, where job growth is very high, where wages are very high, vacancies are quite elevated, and really there's an imbalance in the labor market between supply and demand. So that part of it, which is the biggest part, is likely to take a substantial period to get down. The goods inflation has turned pretty quickly now, after not turning at all for a year and a half. Now it seems to be turning, but there's an expectation really that the services inflation will not move down so quickly, so that we'll have to stay at it, so that we may have to raise rates higher to get to where we want to go. And that's really why we are writing down those high rates, and why we're expecting that they'll have to remain high for a time.
Howard Schneider with Reuters. Thanks for taking the question. You described GDP growth in the SEPs as moderate or modest, I believe. Yet it's really approaching stall speed. Half a percentage point is not much. You described labor market unemployment rate as representing some softening, but it's nearly a full percentage point rise, and that's well in excess of what has historically been associated with recession. Why wouldn't this be considered a recessionary projection by the Fed?
Well, I'll tell you what the projection is. I don't think it would qualify as a recession, though, because you've got positive growth. The expectations in the SEP are basically, as you said, which is we've got growth at a modest level, which is to say about a half a percentage point. That's positive growth. It's slow growth. It's well below trend. It's not going to feel like a boom. It's going to feel like very slow growth, right? In that condition, labor market conditions are softening a bit. Unemployment does go up a bit. I would say that many analysts believe that the natural rate of unemployment is actually elevated at this moment. So it's not clear that those forecasts of inflation are really much above the natural rate of unemployment. We can never identify its location with great precision. But that 4.7% is still a strong labor market. If you look, you've got the reports we get from the field are that companies are very reluctant to lay people off, other than the tech companies, which is a story unto itself.
Yeah.
Generally, companies want to hold on to the workers they have because it's been very, very hard to hire.
Yeah.
So, and you've got all these vacancies out there far in excess of the number of
except for the big tech company. That makes sense.
Like a labor market where a lot of people will need to be put out of work. So that there are channels through which the labor market can come back into balance with relatively modest increases in unemployment, we believe. None of that is guaranteed, but that is what their forecast reflects.
Yeah, Bitcoin's actually holding up pretty well.
Chair Powell, I want to follow up on Gina's question. The decision to step down the pace of rate.
This is where we thought it would kind of stay. 17.8.
Bottomed and now it's bounced back.
Yep.
The past two CPI reports show
not bad.
Inflation decelerating in line with the committee's forecast this year. You just now talked about making decisions meeting by meeting and being mindful of the lags of policy. Does that mean, all things equal, you would feel more comfortable probing where the terminal rate is by moving in 25 basis point increments, including beginning at your next meeting?
So
He's not going to say 25 basis points.
Rate hike to make it to last meeting.
No.
But
I love how they keep asking him the same question.
He's not going to say that.
Having moved so quickly and having now so much restraint that's still in the pipeline, we think that the appropriate thing to do now is to move to a slower pace. And
okay,
that will allow us to feel our way and and get to that level. We think.
So that kind of means yes.
The risks that we face. So that's the idea. It makes a lot of sense. It seems to me, particularly if you consider how far we've come. But again, I can't tell you today what the actual size of that will be. It will depend on
the data,
a variety of factors, including the
data
in particular.
There it is.
The data.
The data in particular.
Come out last week. Do you think it would change some of
the data
forecasts in today's SEP?
No, absolutely not. No, as just a matter of practice, the SEP reflects any data that comes out during the meeting, and participants know that that they can make changes to their SEP during the meeting, well in advance of the press conference, so that we're not running around. But that's not the case. It's never the case that the SEPs don't reflect an important piece of data that came in on the first day of the meeting.
The data. The data.
The data.
Hi, Chair Rachel Siegel from the Washington Post. Thank you for taking our questions. I'm wondering if we could talk about the projection for the unemployment rate. Why has the Fed raised its unemployment projection? Is it because the models suggest that a higher terminal rate would automatically cause a higher unemployment rate? Or are you seeing signs that the labor market isn't quite as strong as we think it is now? Thanks.
No, it's not about the strength of the labor market. The labor market is clearly very strong.
Nobody's firing people.
By now, we had expected. We've continually expected to make faster.
Well, and nobody's buying anything. Nobody's buying cars and houses anymore either.
That's why the peak rate for this year goes up between this meeting and the September meeting.
The data.
We made a lot of progress than expected on inflation. So that's why that goes up. And that's why unemployment goes up, because we're having to tighten policy more. And so it didn't go up by much in the media, I don't think, but that's the idea, is slower progress on inflation, tighter policy, probably higher rates, probably held for longer, just to get to where the kind of restriction that you need to get inflation down to 2%.
Do you have a sense of, in order to get to that number, how much of that could be caused by layoffs versus vacancies trimming or changes to the labor force population rate?
It's very hard to say. You can look at history, right? And history would say that in a situation like this,
they should be firing people.
Declines in unemployment would be more meaningful, I think, than what you see written down there. But why do we think that is the case? So I'll give you a few reasons. First, just is that there's this huge overhang of vacancies, meaning that vacancies can come down a fair amount, and we're hearing from many companies that they don't want to lay people off, so that they'll keep people because it's been so hard. I mean, I think it feels like we have a structural labor shortage out there, where there are 4 million fewer people, a little more than 4 million, who are in the workforce available to work than there's demand for workforce. So the fact that there's a strong labor market, means that companies will hold on to workers, and it means that it may take longer, but it also means that the costs in unemployment may be less. Again, that we're going to find out empirically, but I think that's a reasonably possible outcome, and you do hear many labor economists believe that it is. So we'll see though.
Colby. Thank you, Colby Smith with the Financial Times. How should we interpret the higher core inflation forecast for 2023 in the SEP? Does that not then suggest that the policy rate currently forecasted for next year should actually be higher than the 5.1 medium estimate penciled in?
Well, I think that's why one of the reasons it went up was that core came in stronger this year. Yeah, what you see is our best estimate as of today, for how high we need to raise rates, to how much we need to tighten policy to create enough restrictive policy to slow economic activity and soften the labor market and bring inflation down through those channels. That is the estimate, best estimate we make today. And as I mentioned, we'll make another estimate for the next SEP, and we'll, of course, between meetings we do the same thing, but we don't publish it.
Victoria.
Hi, Victoria Guida with Politico. I wanted to make sure I understand specifically what's going on in the SEP, because you all expect rates to go higher, but you're also more pessimistic about what inflation is going to look like next year. And I was just wondering, given that we have seen some cooling in inflation, is that primarily because
of wage
growth, that you expect wage growth to be sort of a headwind?
No, we're going into next year with higher inflation than we had thought, right? So we're actually moving down to the level that we're moving down to next year is still a very large drop in inflation from where inflation is running now, well more than a 1% change in inflation. But remember that the jump off point at the beginning of the year is higher. So we're moving down still by a very large chunk. I don't think the policy's having any less effect. It's just starting from a higher level at the end of 2022. So we're getting down, I believe the median is 3.5%. That's a pretty significant drop in inflation. And where's it coming from? It's coming from the goods sector, clearly. By the middle of next year, we should begin to see lower inflation from the housing services sector. And then, the big question is how much will you see from the 55% of the index, which is the non-housing services sector. And, that's where you need to see, we believe you need to see a better balancing of supply and demand in the labor market, so that it's not that we don't want wage increases. We want strong wage increases. We just want them to be at a level that's consistent with 2% inflation. Right now, if you factor in productivity estimates, standard productivity estimates, wages are running well above what would be consistent with 2% inflation.
More of the same. I'm done.
Yeah. I'll hear this last one. Let's see if it's any different.
Neil Irwin with Axios. Some of your colleagues have been pretty explicit that they can't imagine rate cuts happening in 2023. That's certainly not implied by the SEP. But futures markets have priced in some easing in the back half of next year. What's your view of the likelihood of any kind of rate cuts next year? What circumstances might make that plausible?
Our focus right now is really on moving our policy stance to one that is restrictive enough to assure a return of inflation to our 2% goal.
That means they're going to raise them. That's what that means. I mean, yeah, this is kind of what I expected. Right? I mean, it's nothing really earth-shattering here. I don't think. He's not showing his cards. I mean,
the only new thing. Whoa. Okay, let me move. The only new thing is, and I'm not going to go back and re-listen to his November deal, but I'm telling you, dude, he is that 2% number. He is screaming that number. He didn't. That number was mentioned a long time ago, and then
that's
never
a ways away.
From ways
away.
So
what's he trying to say there? Like, what's the narrative there?
He's saying we got a lot more rate. He's saying it, but he's not saying it, right? He's not saying we're going to raise. He's using his same vernacular, his same thing. The data, we're restrictive. We're going to be restrictive until the data tells us blah, 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 blah.
Yeah.
But he's also coming back to 2%, 7.1%, where it's at right now, needs to be at 2%.
Yeah, I mean, Luke makes a good point here. He says if inflation's higher this time this year than they projected, then wouldn't it make sense to keep the 75 or go up to 100-point rate hike? So this is what we were talking about off air a little bit. Actually, we were making a video on Clear Crypto's channel. Would you rather just pull the Band-Aid off? Here's a better analogy. Would you rather get punched in the face and get knocked out, but then be able to get back up? Or would you rather somebody just punch you in the gut for 12 months?
Well, I'd rather be punched for a shorter time and be done and move on. That's how I would.
Right.
Get it over
But it
with.
almost felt like Powell was saying more of like the 25 to 50 basis point moves and kind of taking their time because they have such a long time to get to this 2% anyway. Maybe that they'll just do it slower over time.
Yeah. Well, and so go back to they've raised it 425 basis points this year alone. There's been, as of today, there's been 7 interest rate Fed hikes. Never happened in the history of time. I'm going to keep saying that because it's the truth. It's
and how many were 75? You said 4?
4 of them were 75. 4 of them.
Yeah.
None of that. All of that is unprecedented. All that is new. And so massively aggressive, et cetera. Right. Now, but if you look, the effective rate is 4.25. That's the lending rate, which is ultimately what this comes down to. And they've also said that they want to take that effective lending rate to 5.5%.
Mm-hmm.
Okay. Which would mean that we've only got about another 125 basis points, give or take, of interest rate hikes. So does that mean that we're going to have 4 or 5 interest rate hikes that are 25 basis points? And that's kind of what he's saying.
Yeah.
So they're different numbers. You got it. So you got the lending rate number. And if their goal, Zach, is to only get to say 5.5, and you raised the point earlier about, okay, let's say we get to this one, let's say we get to this 5.5 lending rate number. And let's say we get there by third quarter of next year. All right. Okay. Where do we stop? Because at some point they will back off, and then they will let kind of the rest of it kind of do its thing to continue to take that inflation number down kind of naturally through business, through the labor market, blah, 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 all that kind of stuff. That's the X factor. And that's it. And nobody can tell us when and how.
Yeah. Yeah. It's going to be,
but that's what I'm getting. Sorry. That's what I'm getting. I'm getting that they've got another 100 to 125 basis points that they, and I think they will be smaller, maybe
incremental over time, just to kind of be able to understand. Yeah. And I think he's been pretty consistent with at least that part of it, that they've got a long way to go. So that much we can gather. I guess it's just how fast do they want to kind of get there. And I kind of like the smaller rate hikes though, because I mean, as much as they raised 4 times in a row, there's 75 basis points. It didn't do much.
No, because remember, it's always
lagging.
a lagging scenario. So
we could actually gain some ground from now until February based on some of those.
The key is going to be December's jobs report, man. I'm sorry, the December CPI numbers and the December jobs report that we get in January if those are still showing the jobs report that's a tough one, man. Wage increases and it's this tight market. That one is spooky. The jobs report wasn't good this month, but the CPI number showed inflation coming down. Anyway, I think we get another 50 basis points raise in February. I think we do. But if we if we do get a CPI report in January that shows inflation moving down, that could be the factor, Zach, we were talking about earlier, spark points, right? Flash points. If we get a CPI report in January 12th or whatever that date is, it could be a flashpoint to maybe give us some positive momentum moving into February. That's where you get this such contradictory information,
Yeah. It's well, the one thing Jay Powell was saying today too, which is so backwards, is that the job market, just based on what they're doing right now to fight inflation, it's totally opposite of what it should look like.
Exactly.
Totally opposite. I mean, based on
this is okay. No, it's not.
Right.
By
the way, I'm watching the transcript of the responses. It's much the same. People are just asking more in detail.
Question.
Yeah, it's the same kind of stuff asked 10 different ways, and he's pointing to the data, and we'll see what happens.
I mean, look at the last comment there from X and XT level. That's a great screen name, by the way. I think it comes down to this. I think here's what for me, if I was going to sum it up, I would say this. Look, is that we know we got more Fed rate hikes coming. They're coming. And we know we're in a recession. I don't care what anybody says. We're in it. And the key is stagflation, stagflation versus deflation. And that we've had that dialogue. But I think ultimately what it comes down to is I think most people agree Bitcoin, Ethereum, i.e. the crypto market's got some more downside risk, at least in the first 4 to 5 months of 23. So how I'm looking at that is moving to a stable coin position and or all the above DCAing in, because I think Bitcoin and those guys could go lower. But even to your point, Zach, if I buy it at 20,000, that's 2017 levels. That's a great scenario.
And I think that's an important point. You could get bogged down trying to time it perfectly, and then you look up and you could have DCA'd, and 5 years down the road, you're like, man, I've just been better off DCAing and not trying to time it perfectly. I mean, you could always put more into your DCA on days where it's down. So like if we do get that crash to Bitcoin down to 14, 13, 12K, okay, just have cash on hand and buy more on those days. But Travis,
look at RSIs for Bitcoin and Ethereum. Keep your eye on those. Those are biggies. You and I look at RSIs big time.
Yep. And they're very easy indicators to learn. And I got a video out on the Clear Cryptos YouTube channel, one on my channel too, just giving you the rundown on that. And I mean, those are good days to buy for the long term and for trading, regardless if it's short term or long term. So
I just think
buy or sell, depending on where.
I think you've got a buying. So here it is. Here's the silver lining, right? Glass half full. You have a buying opportunity at least for the first 6 to 7, 8 months of 23. I think that's a fair statement. And wherever Bitcoin ends up, Ethereum ends up, top blue chips end up, buying opportunity. If you're looking at a long-term strategy of buy and hold, locking in low cost, whatever the bottom is of Bitcoin and Ethereum and Cardano, blah, 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 blah. Okay, there you go. I think that's an easy one. But lock in those low cost, have a strategy, know what your cost basis is, have a strategy. If I buy Bitcoin at $12,000, I want to make a 30%, a 40%, a 50% ROI on that number. You write that stuff down, you have a note, if I buy it at 12, a 30% return is this number. I'm either A, going to sell along the way, or B, I'm going to sell it all when it reaches that point. I'm going to lock in my 30 points and I'm going to move on. And then I think that's as simple as it comes down. Now, if you're looking at more of a longer term hold, because, I think if Bitcoin goes to 12, I think the upside is $90,000 to $100,000. But that's a multi-year hold. It's not a 3-month hold. I think that's the other thing that we saw in your article, Zach, is that those average cycles were 36-month cycles.
Yeah.
Yeah,
for sure.
And people are not looking at it. They're not looking at it that way.
Yeah.
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 And you've got to look at it that way. That's why I love coming from the stock side into this. It's like, all right, I'm cool. 2 or 3 years holding Bitcoin, buying it at 12 or 18 or 10 or whatever, and going, I'm going to hold it till it's 100,000. All right, cool.
100%. Yeah. You're right. And so many people, I think, came into the markets here recently. So they're unaware of like this long-term mindset, but I think we've got to get there. I mean, because that's what's going to keep people, number one, just engaged in the market. But that's what, we've got to get people that are less here for just the quick fix, the fast cash, and here because they're looking at this as a long-term viable option to invest, a long-term viable sector like they do with stocks. Like you've done for decades, right? I mean, you passively invest.
Yes.
You're not looking at it every day. You're not bogged down by one FOMC meeting. You're not bogged down by one bear market or one flash crash or one company like FTX going under, right? So, and it's tough because it's not as big as the stock market yet, right? I mean, it's smaller, so like there's a lot more volatility, there's a lot more craziness. But I think when you're dealing with Bitcoin and Ethereum, you can get closer to that level of confidence where like, hey, I could just store this away and not look at this at all for a while.
Yes.
Right.
Agree.
Right.
Agree.
Yeah,
I think, dude, you said it. I'm going to reiterate what you said. I think there is this fallacy and there is this misconception. I'm 53 years old. I've been investing in the stock market for 30 plus years. And it's basically a DCA, put money in it every month kind of deal. My point is this, is that the vast majority of people, I believe that are in crypto have this very short-term view. They think it's a get rich quick. I can come in, even Bitcoin. They look at Bitcoin, they look at Ethereum the same way. And that's part of the problem with crypto is that it's viewed as this, it's turn. I can make money so quick. And that's the what's wrong with crypto. I think that and crypto, because it's so young, it will grow up and it will change and that will morph over time. But I loved the content, the article you showed today that showed the average Bitcoin life cycles of those periods of being 36 months. And if you look no further than that, that's what you should focus on. It's like, and by the way, here it is. For let's just say for discussion's sake, Bitcoin goes to 10. Let's just say it happens in the next 6 months. And you buy it at 10, you're sitting there telling me that per the data, the historical data that showed all of these dips and what happened after the dips, if it goes to 10 and it's approximately a 3 to 4 year cycle for my $10,000 investment to go to $100,000, where the hell do I sign up for that? You don't see moves like that in stocks. It doesn't really exist. But a 3-year cycle or a 4-year cycle, hell yeah. And you know what I mean? You see what I'm getting at?
100%. I mean, and I think people definitely have a hard time realizing that if they haven't been in the stock market. I mean, and I haven't been in the stock market like you've been, but I understand like getting a 7 to 8% return is like phenomenal. Like,
oh, you're crushing it. If you're making 8% on your money, you're killing it.
But I mean, so many people are looking for the 100x that that 10x over 36 months sounds like, that ain't nothing, man. That's only a 10x over 36 months. That ain't nothing.
When you sat down with your financial advisor, I remember you told me he's like, do you want to get really risky and maybe like try to go for 12% returns? And that's really risky. I'm like,
right.
That's risky on stocks, mutual funds. I mean, that's opening you up to like international mutual funds and ETFs and all this kind of stuff. 12%. That's risky.
Yeah.
And anyway, you get my point.
I think this market is just so new. I think no matter what, I really believe this, no matter what, however many people combined here, we've got a few hundred people, no matter what, if we're patient and you're diversified and you're invested in the blue chips sprinkled in some, DeFi projects, quick shout out, Clear Crypto is one of those ones that I'm deeply invested in that I think is going to perform very well long-term. If you've got a nice diversified portfolio and you just went away and lived in a cabin and shut off all technological devices for 5 years,
you would
let your emotions just completely detach from your investment decisions,
You would
I
crush
think
it.
you're going to be fine.
Yeah.
So easier said than done, right? Because we can get bogged down with a lot of noise. There's a lot of noise out there.
Dude,
a lot of noise.
Everybody kind of wants to trade crypto. They were like, "Oh, it's only a 2 or 3 month." It's the same thing, dude. Man, I just don't, and it just drives people nuts.
Yep.
Emotional based selling, all that stuff, man. It's just killing you. Anyway,
this year's drove me a little nuts, but I'm not going anywhere. I think a lot of people feel the same way. It's we'll continue to push forward. This is still so early. So many people came into crypto with us. I mean, we're new to the space. I mean, I dabbled in Bitcoin in 2017, but not really. Just bought it passively and didn't even hold on to it, longer than I should have. But yeah, I mean, we're here now, and we've got a couple years under our belt now, and now it's on all of us to kind of pass the torch to the next 4 or 5% of people who come into our space, right? So, and we're in it now. So, hey, man, as always, appreciate you stopping in. Anything else? Parting words for the people?
I loved your analogy. Buy it, go live in a cabin. That would actually, I'm more of a beach guy, but yeah, I get it. But buy the blue chips.
Break away from all the noise. Yeah.
Yeah. Buy the blue chips, diversify, and go away and just leave it alone.
Yeah.
That's what I do in stocks.
Real quick, here's the Bitcoin moves that we saw today. These are 5-minute candles. So this is when the data came out and slowly reversed a little bit.
That other big red one was the beginning of his speech. And then people are, right, that third one, that's the beginning of his speech, I guess. Yeah.
Yep.
And then now everybody's like, yeah, okay.
Yeah, that's actually, you're right. That's exactly where it is. That's exactly the beginning of the speech. And then we've bottomed out and we're almost back up to 18K. I mean, so we got up to almost 18.4 was our high point. Our high was 18,387 in the day here. I mean, all in all, though, it's a pretty good move we've seen here. I mean, right? I mean, look, this is from pre-CPI numbers. So all in all, pretty good move.
Which would bode well. Again, I'm looking for an event, which I know I'm not going to get, right? It would bode well that we should be okay leading into the rest of December and into early January, at least until the next jobs report and CPI report. Unless we get another shoe falls, Genesis, something like that, we should actually be okay. Actually, jump real quickly, pull up the Yahoo page real quick, would you, man? Just see if the stocks are bouncing back. Are stocks coming back or not? Because that's also obviously part of the equation as well.
S&P's back flat.
Yeah, see, the Dow's not coming back as much. Yeah. So crypto's reacting better which does tend to happen. It kind of to me, would you agree, Jack, that crypto kind of shakes off these things a little bit faster?
Yeah, it's just, it's more, it's just more volatile in general, but I think you're right. I think it's, I think it just bounces harder when it does bounce back and it drops harder when it drops. I mean, all in all, I think it's kind of like a wash for me today. Like, I'm not like rah, but I'm not like, oh my gosh, doom and gloom. I'm kind of just like, okay, this is kind of what I thought would happen today. Right?
Well, we were expecting, this is what we were expecting. And I'm focusing on the fact that he's talking about 2%, the data. I love the data. That's been the overriding message of the data, but I also want people to focus on the fact that that the effective lending rate, they want to take it to about 5.5%. And it's at about 4.25% now, which only means we have 125 basis points to go. It's how we get there. I would prefer, Zach, your analogy of the Band-Aid. I wish we could just rip the Band-Aid off, but I think that they're going to slow bleed us. I think they're going to, because it's a lagging indicator, I think they're going to slow bleed it. That's my final.
That's a really good point. That's a really good point. You pull the Band-Aid off and you might not have had to. That's why they do it this way. You're right. You're right. It's a slow bleed because they're getting data late. That's a really good point.
It's always a month. It's effectively always a month behind from a lagging indicator. It is, right? It's a lagging scenario.
And they get more time. If when they do it slow, they get more time in between to kind of assess and come up with a plan.
Well, I mean, we haven't had from today. We get a 2-month break from the Fed itself raising rates, and we get a month break between basically reports, right? We get the next CPI report, et cetera. That's going to be, I'm going to be watching that because is that break should be good for crypto because we get to freaking breathe.
Yeah. Yeah. We don't have something waiting to pull the markets back down.
Yeah.
Well, hey man, this was fun. Thank you all so much for tuning in. If you guys aren't yet subscribed to Austin's channel, let me pull this up. Go check him out. Austin Hilton.
And you have to admit, I'm just better looking than Zach, right? I'm just a better looking guy. I got my shit together.
What do you guys think, man? I mean, look at that guy.
You got the muscles. I got the hair and I'm
I don't have the hair, that's for sure. Oh shit.
I called Zach the other day. I'm gonna call him out. I called Zach the other day. I'm like, what are you doing, man? He's like, I'm shaving my head. I'm like, well, of course you are.
It's a thing, man. It's a thing. Yeah, I did see Shaitoshi Kusama tweeted. I've seen that a couple different times in chat. Nothing crazy. It was like in reference to somebody else. Yeah, it wasn't anything earth shattering. We could pull it up real quick before we head on out. We are waiting on Shibarium. That's a big deal. But all the tweet was it was response to Andrew Tate, who's back on Twitter, by the way. If they kill me, I love you all. And Shaitoshi said, I felt that. So that was all it was. Nothing related to Shibarium. Hopefully we get some news on that soon. By the way, tomorrow, speaking of Shiba Inu, though, guys, Marcy Jastro joining the show tomorrow. So come check us out. We'll be live with her 1:30 p.m. Eastern, talking about the SHIB Metaverse project. So
That's just a little thing in the Shiba Inu ecosystem. Just a small thing.
Yeah, the third. I can't wait to ask her more about the third floor. Ask her more about the conference she just went to, and I'm going to open it up for some people to ask some questions from the community too. So if you guys want to pop on and hang out with Marcy and I and ask her some questions, we'll be live then. So I want to ask about her kind of background too, because she's had a ton of different work in AR and VR and all of that kind of stuff.
Yeah, she seems like a really cool.
Yeah, it should be fun. All right, man. Yeah, I'm gonna get the heck out of here. The sun's shining. I'm gonna get out of here.
All right, man. See ya. Thanks for having me.
Thank you all so much. Appreciate you guys, and we'll talk soon. See ya.